The 10-year Treasury yield has been on a steep ascent since the summer. Today, we're giving back some of those gains as the Fed lifts interest rates. Our next guest says that because the global economy is still doing okay, it will force central banks to push rates higher. Let's bring in Marija, Veitmane, senior multi-asset strategist at State Street Global Markets. Good to see you here, Marija. Your take on today's CPI?
I mean, hugely important market. And I have to admit, we had a higher forecast, so it's a bit of a surprise for us. But nevertheless, it's always nice to see equities in the green. So that's not a terrible news. But I think what we cannot forget is that despite the kind of monthly number being below expectations, and it gives us some relief to markets, we still see inflation being very high. I mean, headline is above 7%, core just shy of 6.5%. So we're still living in fairly inflationary world. Maybe a little bit less than we were worried about, but Fed's job is definitely not done.
For some of the areas that inflation is still persistently sticky right now, what do you believe it's going to take in order for the consumer to ultimately see some of those prices abate?
Yeah, so there are kind of two parts of the consumer trends we're thinking about. One is for higher income consumer, more affluent consumer. We still see quite a lot of savings on their kind of balance sheet. So they saved money during COVID as people were not going out, were not spending. So there are some of those savings are still there. But more importantly, for lower income consumer, kind of marginal consumer here is labor market. So labor markets remain strong. That has traditionally been a very important driver of consumer sentiment, consumer spending. So for now, we haven't seen a lot of evidence that's going away. So that's something we are watching very carefully.
How much labor market weakness do you see next year, if any?
So that's a $1 million question, really. I mean, historically, you would say that when rates increased as much as we've seen so far this year, labor market would be a lot weaker. I mean, right now is obviously not normal times, not normal cycle, is that because post-COVID, what we've seen is that participation rate has come down. It has come down because lots of people kind of left labor force. And the detail that's important to realize is that the people who left labor force are kind of older demographics, so it's very hard to draw them back. So indeed, interest rates need to increase a lot to slow labor market.
A lot of companies are increasing their focus on wages as well, given some of the operational expenses and the general and administrative expenses that they have to really account for. By the time we get into next year and the employment situation looks perhaps vastly different, what do you imagine the correlation between the real wages that employees are receiving is going to look like against the backdrop of inflation?
Yeah, very challenging situation so far. I mean, what we're seeing right now, wage growth is lagging inflation growth. So that's a huge challenge. And I mean, all over the world, people kind of demanding higher wages. And what we know as tightness of labor market kind of makes that so that lots of companies, lots of employers have to kind of pay those wages, which is obviously eating into their margins. When the economy slows, and I mean, at that point, possibly we'll see layoffs, and maybe we'll see kind of weakness in wage growth. But definitely very challenging situation for corporates.
Marija, we're just getting now a statement from President Joe Biden on the CPI index, noting, quote, it will take time to get inflation back to normal levels, and we could see setbacks along the way. What does normal inflation look like?
Yes, that's a very good question. I mean, historically, we thought that 2% inflation is normal. Right now, that's a very far away target, and lots of economists are thinking maybe it should be a bit higher, and then kind of central banks' challenge of price stability without hurting growth too much would be a bit easier, because to get inflation to 2% would require quite a lot of slowdown in the economy, which is kind of people losing jobs, corporates going bankrupt. That's not something that central bank particularly wants to impair on the economy. But having said that, they need to fight inflation. So maybe getting to this idea that normal inflation is not 2%, but maybe a little bit higher, that can be maybe a constructive conversation.
State Street senior multi-asset strategist Marija Veitmane, thank you so much for joining us this morning. We appreciate it.